Welcome to Volatility Trading Strategies. So words can hardly describe what's happened in the volatility complex in the last week, but I'm going to do my best to find a few words and just give a little update as to where we stand now. But it's going to take a little while to unpack all of this, so expect multiple follow-up videos in the coming weeks and months. And to be honest, maybe years. I was only 12 years old when the famous Black Monday crash of 1987 happened. I probably didn't even know what the stock market was back then. I was much too busy ripping it up on my BMX bike to care what was happening. But I am a student of history, and I think you have to be a successful investor. And still to this day, I do use that day as a reference point for how bad things can get. Now, this past Monday wasn't nearly that bad, and at the end of the day, the S&P 500 only dropped about 4%, so this is hardly Armageddon. But in the volatility complex, this is sort of like a mini Black Monday for our generation. So let me go through a few charts and explain what happened. So the first thing we can look at is the record-setting move made by the VIX. So the VIX index is the Chicago Board Options Exchange Volatility Index. It's a measure of the forward implied volatility of the S&P 500. Basically, a statistical snapshot view of what market participants are expecting as far as forward movements in the S&P 500. The higher the number, the more volatile we're expecting things to be. You can see in this chart, before this Monday's epic spike, the previous record came on February 27th of 2007. If that date doesn't ring a bell, it was an interest rate scare in China that caused some ripple effects in the US and a 64% single-day spike in the VIX index. And then below that, you can see a lot in the 30 to 50% range. Well, how about that 115.6% spike from this past Monday? And you can see it came on a day where the S&P 500 itself dropped only about 4%. There's 5 dates on this list that saw larger stock market crashes than this past Monday, but the VIX reacted violently. For followers of mine, you'll know I've been talking for the past year about the growing risks in the volatility market. It's been a very interesting time with volatility being suppressed to historically low levels. The black line here represents the VIX index values going back to 1990. Which is as far back as we have VIX values for. The red lines represent every time the VIX index had a daily closing value below 10. The 1990s was a historically calm period and was also the longest bull market in history. Even then though, the VIX only closed below 10 5 times that whole decade. From 2000 to 2010, there were only 4 VIX closes below 10. In the 2010s though, 59 times the VIX index closed below 10. And every one of them in 2017 and the first week of 2018. These are low levels of volatility that we've never seen before. And as far as the stock market goes, last Friday, the day before our Black Monday VIX spike, the S&P 500 finally ended its unprecedented streak without even a 3% correction. Not since the US election in late 2016 has the stock market even seen a 3% drawdown. Markets that only move in one direction are dangerous. Now that doesn't explain the whole 115% VIX spike, but it's not that surprising in the context of this coiled volatility spring that we've loaded in the past year. Any market move at all was going to have an amplified reaction. The rule of the day since the election was buy the dip. Any moment of weakness at all was met with heavy buying, and a lot of volatility traders out there were shorting volatility on every VIX spike. And in a world dominated by high-frequency trading and an ETF market that basically means that all boats are going to rise regardless of merit, and an increasing appetite for short leveraged volatility bets, and that 4% move was enough to just flip the switch. It crossed the tipping point where every algo and everybody that was buying the dip and shorting every VIX pop, it suddenly went the other way in a big hurry, and that brings us to the XIV. On Friday afternoon, the XIV closed at a price of $115.55. Now there's an acceleration clause in the prospectus for XIV, which I've talked about in the past. I'll put links here to a couple videos where I explain it and mention that it's certainly possible that it could be triggered. But what the prospectus says is if there's a single day loss of over 80%, the ETN can be terminated. So during the last 15 minutes of trading on Monday, the floor really fell out and it easily breached that 80% down threshold, dropping well into the 90s% drawdown. It's already been announced by Credit Suisse that they will be terminating the XIV. That'll happen in a couple weeks. It's a sad day because, as I mentioned in a few videos, XIV is the ETN that has by name become synonymous with the short volatility trade. In the beginning, it was VXX and XIV that originated all of this. Now, as far as we know right now, XIV was the only volatility product to be terminated during this recent spike. SVXY, XIV, even VMIN seems to have survived, and of course all the usual suspects on the long side are there as well. That's VXX and UVXY. Now, this certainly could change as we get more information, but as of now, it does appear that way. Unfortunately, the original product did get the worst of it. Now, just quickly, because people will be asking, our VTS community and all of our volatility strategies were not affected by this. These are all the times the XIV has crashed over 10% in a single day. There's been 37 of them in its fairly short life cycle. This time around, we were 100% in cash in all of our volatility strategies, as there were plenty of danger signs leading up to this. Overall, we've avoided nearly 90% of the worst days, including the kill shot this past week. So the event that many in the volatility space assumed couldn't happen, unfortunately has happened. And some of those old stories we heard about people making millions of dollars shorting volatility, they may have a little bit different context now. Some of these stories, unfortunately, are not going to have happy endings, and it is really sad. But there were warning signs. I'm not much of a social media guy, to be honest, but I am on Twitter a little bit, and last Friday I was seeing a lot of reckless calls being made by people recommending to short volatility into the weekend, and I threw out this tweet. Watching all the contrarian short volatility trades being shouted out today, it's almost as if people think volatility trading began in March of 2016. No respect for history. Careful here, folks, you don't have to swing at every pitch. Now, I'm not Nostradamus, and I certainly didn't think that one day later we were going to see an XIV termination event, but the writing was on the wall that something was up, and being in any volatility trades was very risky. Obviously, long volatility would have worked out very nicely, but I do think that during those ambiguous times where it really could go either way, it's best not to be long or short volatility. Both of those were risky trades. One of them worked out, one of them unfortunately didn't, but as I always say, cash is an active portfolio position. There's nothing wrong with sitting on our hands and waiting for a little bit more clarity. So the big question is, what happens now? Is this volatility trade broken? No, not even close. In fact, with market calamity comes opportunities for those who have preserved their capital. And I don't just mean money, I mean preserving emotional capital as well. Not riding those emotional roller coasters is preserving capital. Volatility trading existed back in October 1987. Options, swaps, there were ways to harvest the volatility risk premium back then. More archaic, but there were many ways. Like I said, I was 12 years old and oblivious, but I can't even imagine how many traders were blown up by the events on that day. But did trading end the next day or the following months and years? No, it got nothing but stronger. So I see this as an opportunity. It's horrible that people lost money, and I'm truly sorry to each and every one of them who did. I don't like to see anybody get hurt, but the death of the volatility trade has been greatly exaggerated. Our VTS community will push forward as usual, by allocating conservatively, by diversifying across multiple strategies and asset classes, and being prepared to move to cash at the first sign of trouble. Investing is really hard, and it is best to do it slow and steady. I know there's temptations out there and easy money trades being dangled right in front of us, but in order to survive for 20 to 30 years, we really do have to have the discipline to not swing at every pitch. So if you have any questions at all, especially during a week like this, feel free to reach out and ask me anything. I'm always here to help. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.